Hello, in this video, I'll be going through a comprehensive problem with a finance sales type lease that has a guaranteed residual value. I've had to break up this video into two. My first video is to learn how to do it from the lessor side, and this video will be from the lessee side. I'll go through the facts first, and then I'll skip into the journal entries and the calculations. On January 1, 2027, Gosh Industries leased a high-performance conveyor to Carrier Company for a 4-year period ending December 31, 2030, at which time possession of the leased asset will revert back to Gosh. The equipment cost Gosh $956,000 and has an expected useful life of 5 years. Gosh expects the residual value at the end of December 31, 2030 to be $300,000, and negotiations led the lessee guaranteeing a $340,000 residual value. Equal payments under the finance sales type lease are $200,000 and are due on December 31 of each year, with the first payment being made on December 31. Carrier is aware that Gosh used a 5% interest rate when calculating lease payments. The first thing I like to do is I like to write down all the information just so I can see everything in a glance. And these are all taken from the lessor video, so I'm not going to rewrite it. But I write down the lessor is Gosh, the lessee is Carrier, the cost of the asset being leased is $956,000. That only comes into play on the lessor side of things, so we will not use that information in this video. And the term of the lease is 4 years, and the interest rate is 5%. Additionally, we are told that the expected residual value, that's what RV is $300,000, and the guaranteed residual value is $340,000. So let's go into how do we calculate the journal entries for the commencement of the lease and for our first payment on December 31st. So let's go right into that. I'm going to skip all these other ones that I did for the lessor. So now we're doing the lessee side of things. The lessee. So for the lessee, for the lease, the lessee is going to record a lease liability and a right of use asset. That's what they record. And the way we're going to calculate what those amounts should be is it's going to be two-part. Number one is going to be the present value of the lease payments. And we're told the lease payments are $200,000. And the factor that I'm going to use is the present value of an ordinary annuity because we're told, sorry, this is working weird. We're told in the problem that the first payment of the lease is made at the end of the year. It's not made on the first day of the lease. So we're going to use the present value of the ordinary annuity factor tables. If you're not familiar with how these work, please look at prior videos for how to calculate present value. And we're going to use the lease term is 4 years. So that n equals 4, and the interest is 5%. That's what we're going to use. And when we do that, our factor is 3.54595. And that gives us the 200,000 times that factor equals $709,190. So that's just one part of how we calculate the lease liability and right of use for the lessee. If there is no residual value, nothing else, no bargain purchase option or anything like that, this would be our, we would book this entry for $709,000. However, there is a guaranteed residual value component to this particular lease. And I scrolled up because I have this table right here that shows how to treat the guaranteed residual value from the lessor side and the lessee side, which is what we're going to focus on in this video. For the lessee, so this is, do you include the present value of the residual value into the lease liability and return of use asset amount when we first get into the lease. If the expected residual value is greater than the guaranteed residual value, then we do not include it. And that makes sense because if the expected residual value is higher than what we can guarantee, then the lessor, when they get that asset back, they can go out and sell that asset and get that expected residual value back. So we don't do anything. We're not going to owe anything additional if that's the case. However, if the expected residual value is less than the guaranteed residual value, then the difference between those two has to be included in our lease liability at its present value. So let's go through that. We're told the expected residual value in this problem is $300,000, and the guaranteed residual value is $340,000. So in this situation, our expected is lower than the guaranteed. And therefore, if we go back up to our table, when our expected right here is lower than the guaranteed, then we have to take the difference, the $40,000 difference, this $40,000 difference right here, and we're going to present value that amount and include it in our lease liability amount for the lessee. So part one of the, scroll up just a little bit, right there. So to calculate the lease liability, I have the present value of my lease payments plus the present value of my excess residual value, I'll call it, which is $40,000. And I'm going to multiply that by the present value of a dollar table, because this is just a lump sum. Again, I equals 5% and N equals 4. And that factor will be 0.8227, which equals to 32,908. So when I sum up these two numbers, the 709 plus the 32, I get $742,098. This is going to be what I'm going to book my right of use asset and my lease payable for the lessee. So let's book that entry. So this is the start of my lease on 1/1. I'm going to debit right of use asset for $742,098, and I'm going to credit lease liability for the same amount, $742,098. Okay, now let's fast forward to December 31, where we have our first lease payment for $200,000. And the way I like to do this is I like to set up my own little amortization schedule. So I'm going to have my cash payment, interest expense, because we're the lessee, my decrease in my lease liability, and my carrying value of my lease liability account right here. So on 1/1/27, we recorded lease liability for $742,098. 12/31, we made our first payment for $200,000. And so we need to split that up between the interest component and the decrease to the lease liability. The way we're going to do that is we take our beginning lease liability carrying value, which is $742,098, multiplied by the interest rate we use to discount this number, so times 5%, which equals to $37,105. This is going to be our interest expense component. So if I go here, let's just pick a different, 37,105 is the interest. And so then the decrease in the lease liability is going to be the difference between the payment and the interest expense. And that number is $162,895. Then we would take the lease liability minus the 162 to get a new carrying value for the lease liability as of 12/31, but we're not going to do that right now. And so when we're the lessee, we have two entries we're going to book every point that we make a payment. And the first entry, let me back here. The first entry is I'm going to record this payment. So the payment is I made a cash payment, so I'm going to credit cash for the $200,000, and a portion of it is interest expense. So I'm going to debit interest expense for $37,105, and the remaining, the difference is going to be the decrease in my lease liability. So I'm going to debit that for $162,895. That's the first entry. The second entry, so that kind of addresses what we do with this lease liability account. The second entry that we need to deal with is right here, is how do we amortize this right of use asset down? So the way we do that is we do it straight line. In a finance lease, we're going to do it in a over the straight line over the term of the lease. So we're going to take 742,098 divided by the terms of the lease, which is 4 years, which equals 185,525. And the entry to that is going to be debit amortization expense for that amount, the 185,525, and I'm going to credit my right of use asset for the same amount. Use asset for the 185,525, such that at the end of the 4 years, the balance in my right of use asset will be 0. And if we were to take this schedule out, right, to the end of the lease term, the lease liability balance would also be 0.